Hello and welcome to the Space Between Ideas. I'm Blaine Gates. Welcome to spring version of the Space Between Ideas. I got a nice little sofa chair and I moved my office to a new room. The temperature is not less than 10 degrees now at night, and that means that we are now in a new reality. We are in the later half of spring and we are beginning the late spring summer season, which is great, which means that we survived. I literally survived an entire winter without heat. I didn't heat my home and I didn't heat my water. Today, I took a nice cold shower and it wasn't painful for once. So, anyways, let's get into the material today. This is kind of a challenging subject. If we go back to what's happening in the news right now in the world, so it's now 2026. It's May 9th. So in Russia today, they had the big celebration with their patriotic day, and yeah, it's really interesting. So we also have a situation where the United States has run into some issues with the situation with their special military operation. Remember that the Russians, when they went into Ukraine, used the term special military operation, and then now we have the United States. So there's something about the United States where the the American president, he can conduct war for 60 days. And when the 60-day period is over, then they have to get congressional approval. So there's something happening in the United States right now where Marco Rubio and Donald Trump, they're kind of saying like, okay, so that 60-day thing is over. And then if something starts now, this is going to be a new 60 days. So this is the issue that they're playing with. And I talked to a guy from Saudi Arabia today. So I have quite a few people that I talked to during the week. I talked to a man, he's from Russia. He's a former parliamentarian from Russia, and we discussed the Patriotic Day, and we talked about some other things about history, about 1917 situation in St. Petersburg, the fall of the monarch, the rise of the bourgeoisie. I talked to a Chinese lady in Japan. I talked to a Russian guy in Kazakhstan. I talked to all these people around the world, and in general, I would say like there's a real feeling of fear around the world right now. People feel really uneasy. The guy in Saudi Arabia, he says, well, there's a lot of news about Pakistan and India potentially using nuclear weapons. And then Trump came out a couple of days ago and also said, hey, guess what, guys? I'm thinking about using a nuclear weapon. And it's like, what is going on? It reminds me of like chapters. So chapters in history. So there's certain things that happen in history that they start to give you the feeling like maybe we're on to a new chapter. And I remember feeling this way when Russia started bombing ISIS in Syria, and I could see something was happening because the Americans are like, "Hey, why are you bombing ISIS?" And the Russians are like, "Well, I thought these were terrorists, so why can't we bomb terrorists?" And then the United States were kind of like, "Well, they're our terrorists." It's like, what do you mean they're your terrorists? You can't have terrorists. Yeah, but we're like, so they were stuck because they couldn't explain where these terrorists were coming from. And then Russia just kind of like said, well, if they're terrorists, we can bomb them. So this is now the situation where we just reached a new chapter, and um, Iran has now decided to rename the Strait of Hormuz to the Strait of Persia. They've set up their system for boats that need to make payments, and the United States is flat-footed. So they're like, what do we do? We did a special military operation, which was not successful. The issue about this operation, it started when they did some kind of like financial manipulation in the markets to drop the valuation of the currency. And at the time, they already had a lot of the Starlink terminals in the country, and they had this whole process that they were planning on trying to create some kind of coup or trying to storm the government. But unfortunately, what happened is the government killed, I don't know, what was it, 4,000 people? Was it? I don't think it was 40,000. Was it 40,000 people? No, 4,000. There was like a big number, 4,000 people, and so they just slaughtered all these people. And the question is, who were these people? And from the Iranian perspective, it seems like these people were people who were connected to this attempted coup, this attempted overthrowing of the government. And so from the Western perspective, everybody was saying, oh, okay, like, Iran is killing their own citizens. But from the Iranian perspective, it was more like, yeah, we're killing the people who are trying to overthrow us. And so that's the thing when it comes to dictatorships, is that when you have America who is going to overthrow your government or is going to drop bombs on you, what happens is it strengthens the need for a dictatorship, because if you have a if you have a democracy, then it's easy for the Americans to come in, give their money to one of the parties of that democracy, and then start to take over the government. And so what happens is when you are like an enemy of America, you have to run you have to run a dictatorship, and you have to maintain political power, which creates a brutal system of dictatorship where these dictators demand absolute control. And it's required because the problem of the Mossad and the CIA and the MI, whatever number they use, and all of these different forces who are encroaching on your country. Now it's much easier in China because they're Chinese. Like a black guy comes into Russia and you're like, hey, I don't think you're Russian. And anybody goes into China and it's like, I don't think that you're Chinese. So it's kind of easy to spot. Persia, if you watch that, remember there was that one TV series between Gaza and Israel, talking about the conflict between Gaza and Israel. And the thing is that like these guys, they grow a beard, and these Israelis can go into Gaza and they're not noticed. So a lot of things are happening, but what I was really thinking about this week is about land. People trying to take over land. And why are they taking over the land? Because they want the resources. And if you look at the past videos that I've made, then you're going to see that that was the main issue, was like how to get resources from the land. And then today we're going to move from land to resources to capital. We're going to be talking about capital today. And if you're new to capital, then this could be a challenge to understand everything we talk about. I'm relatively new to capital, and so I would suggest that the things that we talk about are going to be relatively simple in comparison to what someone might expect for a deep dive about capital. Anyways, let's have a discussion about capital. Let's see if we can fit that for fitting. Well, I guess you can't really see the bottom. Now this is just a thumbnail. We're not going to use this to talk about, I don't even know what this is talking about. All right, so I guess it's just trying to introduce some of the topics that we're going to talk about today. For example, over here we have the 3 pillars of investment. To win, go against the grain, intelligent investor framework. So on this side we have investment. Over here we have speculation. All right, so this is only one very, very small aspect of the presentation. So let's begin from the very beginning. And all right, let's begin. Now you can see that the title of the video is the mechanics of assurance. And the first argument that I'm going to try to make is this idea of assurance, because our main question is like, what is it actually? And so if we want to understand what money is, then we have to understand what assurance is. Huh. All right, so up here it says the bridge from macroeconomics to personal wealth. We have established why some nations start rich and others start poor. mapping the impacts of geography, disease, technology, and institutions. Now the question becomes deeply personal. All right, so that's talking about in the previous videos that we made. We talked about geography, and we talked about disease, and then we talked about the rise of technology and how that started to um, influence the farmers and Europe particularly, and also China. And then we talked about the development of institutions, but not we didn't really talk deeply about institutions, but mostly about how there were some changes in government and conquest and just general changes during the Dark Ages. Given the world as it is, how does an individual build wealth within it? To answer that, we must return to absolute basics. We must accurately define three things. What is money? What is a market? And what is the precise definition between investing and gambling? Everything that follows depends on getting these three answers right. All right, what is money? Let me just check one thing. Hello. What is money? What is a market? And what is the precise definition difference between investing and gambling? Okay, this definitely not this mic. All right, let's go. Okay, so stripping down money to its core promise. So you can see in the picture, we have something called an IOU, agreed value transfer, and then you have some goods. And this goes back to this a general idea of how my understanding of money. Let's read first. Strip money down to its absolute core, pound it into a powder, and it resembles only one thing, an IOU. A money is an IOU. The mechanics require access to resources and mutual value. You have access to resources, and I have access to resources. We value each other's resources, agree on an exchange rate, and draw up an IOU. Money is not the wealth itself. Money is the agreement to transfer wealth. Physical paper or coin is not the thing. The paper is simply the promise that the transaction will be completed exactly as agreed upon. All right, so that's the whole point of like, okay, so we have some coins. I don't have any money near me right now, but like the coins, the actual coins that you have in your pocket, the actual thing that you have, this thing you call money, the paper, or like the numbers inside of your bank account, or like however you hold your money, it's a representation of something, and it's a representation of assurance. Because if you ever heard of something called like a inflation. So what do you mean inflation? Why is it that my piece of paper, it doesn't buy the same amount of goods as it used to buy? So that means that there's something changing about the way that people are, the belief that people have about the value of that representation of money. Okay, so let me try to make that a little more simple for you. So let's look at this very specific example. All right, so I don't know if when the example comes up. Yeah, it's going to come up. All right. All right, so the first idea is just, it's called an IOU. All right, so let's go actually deeper. Let's go back to the concept of gold. So early in American history, you had people, and the people had gold, and everyone agreed that gold was valuable. Everybody wants gold. And for thousands and thousands of years, everybody agrees that gold is something that can hold its value. And you can also break the gold into smaller pieces, and you can do lots of things with gold. So if everybody recognized gold as something valuable, then that's a good thing. And then what happened was there were these guys, they're like, hey, why don't you just leave your gold here, because it's really heavy and someone might steal it. And so I'm going to give you a piece of paper. The piece of paper, you can trade the piece of paper to somebody else. And it's a representation of assurance. It means that if whoever holds this paper has access to this gold. All right, so that's the whole point. And like, for example, even in this picture, you can see whoever has access to this little piece of paper has access to goods. So people want paper because it's very light, and then they can take the paper to somebody else and they can say, look, I have a piece of paper. And they're like, yeah, I recognize that paper. So give me the paper and I'll give you something for that paper. And so everybody's happy to use paper. It's only a representation of some little piece of value. And as long as we all agree on that value, then we can all use that same piece of paper. The invisible foundation of all finance. An IOU is only as reliable as the assurance behind it. If goods are passed across the table immediately, the IOU is settled and extinguished instantly. All right, so it means like, okay, so I have like a chicken and you have like a cast iron pot, and I need the cast iron pot and you want the chicken. And so I push my goods to your side of the table. Well, my chicken actually walks over to your side of the table, and you push your cast iron pot over to my side of the table, and that's it. There's no IOU. The only risk here is the belief that you're not going to hurt me or try to steal from me. So as long as I have trust in the exchange environment, then that means that there's no need for an IOU because we're passing actual goods. Both sides are fulfilled. But if one person takes the goods now and promises to deliver value later, the agreement requires something stronger than a handshake. All right, so the issue arises when we make an agreement, and the agreement, for example, I'm going to give you seeds today, and then you're going to plant those seeds. You're going to grow something from those seeds, and then you're going to return my original seeds back to me, plus you're going to give me a little bit of extra seed. All right, so that's the agreement. Okay, but you're promising me, I'm giving you seeds, real seeds right now, but then so I'm like, there's a huge amount of risk, and like, what are you going to give me in return? Like, how does anyone know that I gave you these seeds? And that's where that piece of paper appears. So that's when they give you a piece of paper, when they give you money, it means that this is some vehicle, some way of holding this assurance or this agreement. Assurance is the belief that an agreement will be honored in the future. It is the invisible foundation of all finance, strengthened by external devices, contracts, collateral, reputation, security cameras, even guns. Every financial system in history is, at its core, a machine built to manufacture assurance. All right, so in fact, the entire society is built on this type of assurance. So when we talk about the foundation of government, then of course people like to say that the foundation of government is the police power. Well, what is the police power? The main need. Why do we need police? The main two things that we're worried about are theft and murder. And so the police power is the thing which fights against theft and murder. Now, if we can protect our citizens from theft and murder, then it means that when we trade with each other, then there's an assurance that nobody is going to steal from each other and nobody's going to kill each other. And so the whole idea of government is also the assurance of government is the assurance of money. It's the assurance of transaction. It's the assurance of business. It's where we can improve our productivity, and we can work together without the fear of being of someone stealing our goods or killing us. All right, so let's take a look at this promissory note as a time machine for value. What happens when need exists today, but the money won't be earned until tomorrow? All right, so in this one, we have the present. So present need exists today. A person gives a promissory note to person B for $1,000 plus interest. Person A text is garbled. Person B receives a $1,000 note. The person B trades the note to a person C for the bicycle. The person C holds the claim. What is going on? Person B owns a bicycle. Person B performs future labor. A person A receives 1,000 plus interest. The person B repays person C with interest, the future labor and repayment. All right, so on this side, it says like, okay, I need a bicycle. Now, why do I need the bicycle? Because if I had a bicycle, I could be a delivery man. And if I was a delivery man, then I would be able to make more money. And so I want to make a deal with you today that you are going to sell me this bicycle, or you're going to sell me this, you're going to give me the money for the bicycle. So you can go to the bicycle person and you can negotiate financing, meaning that you give me the bicycle today. I take the bicycle, I use the bicycle to make money. Then I bring back the money plus interest. All right, that's a promissory note. So that means that I need the money now, but I'm going to pull future value. I'm going to pull value from the future and I'm going to bring it into the present. I'm not actually passing my chicken across the table. I'm passing a piece of paper across the table, and I promise you in the future, that thing is going to turn into a chicken. So it's magic, right? Like this is way beyond like monkeys in the jungle. Like we're imagining some future benefit and we're pulling it into the present. All right, so scenario is a person has a 1,000. We talked about that. Here's the instrument. I will pay you back in the future, and then there's the execution. Let me hide this. Okay, so the original $1,000 was never duplicated. Instead, B's future productivity was literally brought into the present. A promissory note is a time machine for value, providing that the value is ultimately a product of work, either completed now or promised in the future. So it's magical. So first, we just traded physical goods with each other. Now, the thing is that we didn't actually need coinage. We didn't need a promissory note. We didn't need a piece of paper as long as there was trust or assurance in the system. So let's say that, like my neighbor, I say, "Hey neighbor, can I borrow some sugar?" And they say, "Well, why don't you use sugar? Why don't you? Okay, what are you going to give me in exchange for the sugar?" And it's like, "Oh, well, I'm going to give you a promise." What's the promise? The promise is that I'll give you back the sugar tomorrow. So it's a promise. Unless they trade for something else. The bank is a financial intermediary. At the beginning of finance, the architecture of lending was simple and direct. So we got the saver on the left-hand side. I need someone to protect my money. I will provide it to someone who can use it, provided they pay me a return. All right. So in our past videos, we were talking about physical goods. We were talking about farming. We were talking about war. We were talking about the rise of clocks and the rise of engines, the rise of technology. And then suddenly when you have all this technology, then you start to have the capitalist. And so you have the factory owner. And then the factory owner is, how do they provide for their employees? Because now we have multiple employees. And so how do we deal with this? And then so how do we keep the books? You know, at the end of the day, money it's a system of keeping track of who holds the value. Now, we could also use the word energy. So then another question is, who holds the energy? So why is it so important for Iran and Russia and America and all of these countries? Why is it so important that they protect their land? Because inside of their land, they have oil, and that oil can be burned and it produces a powerful amount of energy. So there's a huge amount of energy. You know, some people, they say, like, long after the United States and Russia run out of oil, Iran is still going to be pumping. And so the thing is that you really want to conquer Iran, because once all of the other oil reserves are gone, what are you going to use for power? Now, China has a better model because China already understands they don't have enough energy. And so they're focusing all of their efforts on making sure that everybody is focused on productivity. Everyone's focused on work. And so they understand, yes, we don't have that energy, but we have human energy and we have machines. So we can buy the energy from somebody else and give them manufactured goods. So at the end of the day, what would you rather have? Would you rather have the energy, or would you, I mean, like the energy to power the machine, or would you rather have the actual machine? And that's actually like a big problem right now, because we're going to move into the next section of history where we have these things called smart engines. So in the past, we had engines. We transferred like human energy and animal energy into actual mechanized metal and fire and pressure using oil. But now those machines are becoming smart. Okay, so what's the difference between a smart machine and a human? Oh, now we got an issue. All right, so we transfer that energy. We have all this extra energy, and where are we going to put the energy? If it's a battery, okay, what's a battery? A battery is a bank. What is a gas tank? A gas tank is a bank. And so we have all of these different reserves of energy. And one of the reserves of energy is digits, and we put those digits into banks. I will protect your money for a fee, and I'll lend it to someone who needs it. I'll keep the spread. All right. So then the borrower says, I need capital to start a project. I will pay the bank back with the principal and 15% interest. Okay. The bank itself is not creating wealth. It acts as an intermediary, efficiently connecting surplus capital to productive opportunity. This closed system works perfectly, provided everyone honors their promise. Bending the rules with fractional reserve lending. All right. So now this is like a strange investment. It's also built on the idea of assurance. And what is the assurance? So the assurance, what the banks are looking at, they're looking at the overall security of their environment. And when you live in a secure environment, then what you can do is you can feel relatively confident that not everybody is going to run to the bank and try to take their money out at the same time. So, I mean, in some ways you could say that they cheat. What does that mean, cheat? Okay, so all right, so like I started dating other girls. What do you mean you start dating other girls? I thought you were married. Yeah, but I was relatively sure, I was sure that my wife wouldn't see me when I was at work and then I went to lunch with this girl. So because of that assurance, then the risk is almost zero, and so I decided to take on that risk. All right, so is fractional reserve lending, is that cheating? Because what happens here is, let's read. The simple intermediary model assumes the bank holds all your money. It does not. Under fractional reserve lending, a bank keeps only a fraction of its deposits on hand, lending out the remainder. Your initial 1,000 deposit becomes $900 lent to a borrower. That borrower deposits it elsewhere, where 810 is lent out again. The same original 1,000 now supports multiple simultaneous claims. Money is being actively created not from work, not from goods, but from mathematical act of lending itself. This mechanism is the engine of modern finance, but it is also the greatest systematic vulnerability. Okay, so where are we going, and where did we come from, and where are we going? So where we came from, it was this place where I give you something now, you give me something now. Ooh, ooh, we were monkeys, all right? So you give it me now, I give you now. And it's like that there was zero trust system. The only trust was, I'm not going to steal from you and kill you at this exact moment. If you believe that the other person is not going to steal and kill you at this exact moment, we can make a trade. Then another higher level of assurance where, okay, I'm going to give you something now, and then you're going to promise you're going to pay it back with interest in the future. This is a huge leap in trust. And now we're going to, in this system, what we're doing is all of the whole society agrees that we want to keep the majority of our money inside of the bank. And then what the bank can do is they can hold a very small amount of cash on hand. They can lend out that same energy again and again and again. They're pulling money out of nowhere. Like, it's not real money. They're pulling something out of the future. They're pulling, and it's not just one future, it's multiple futures. So as long as everyone keeps their money in the bank, and as long as enough people are able to pay back the original capital, the principal, with interest, then in fact suddenly, boom, it just explodes, because of it's just a mathematical formula. Because we all trust each other, then we are able to give each other access to imaginary future value, imaginary future energy, and we turn the imaginary future energy into actual productive capacity. So it's quite amazing. But it's cheating. Why is it cheating? Because sometimes, every so often, a situation occurs where either not enough people are able to actually produce, they're not actually able to take the value from that system. So, for example, I borrow the money, I go buy the bike, and then I'm riding the bike, and then suddenly I ride off a cliff, and then the bike is destroyed and the human is destroyed. Who's going to pay back the money? All right, so then the question is, who took on the risk? The bank took on the risk. Okay, but what happens if 1,000 people drive off? What if there's an earthquake and all of the bicycles in our region, all our delivery people are riding off of cliffs, their bikes are destroyed, no one's able to pay back that capital. And then suddenly the guys who lent the money to the bank in the first place, they come to the bank and they say, listen, my understanding is that a huge amount of people that you lended money out to, they're not going to be able to pay you back. So can I get my money back? And then one guy takes his money, the next guy takes his money, the third guy, and suddenly all the money's gone. And then there's a piece of paper. And okay, so we still have this amount of money lent out, and then we have this amount of money we need to pay back to the people who lent money to us. But this money is never going to get paid back. Therefore, we cannot provide that money to these people. And then what happens is this bank is bankrupt. Bankrupt. A rupture of the bank. All right, so the economic growth cycle requires a surplus. Economic growth requires one fundamental ingredient: time freed from baseline survival. I have no idea what this slide is about. Stage 1 survival. 100% of the time is used for food, shelter, clothing. There's zero surplus. Economic growth simply equal. This sounds like, what's his name? Peter Schiff. He's got his book about where money comes from. And stage 2, tool advancement. Better tools emerge. Basic needs now require only, basic needs now require only, why does it say require only twice? 80% of time. The remaining 20% is true surplus. So what is that saying? Is it saying we have more time or we have more output? It looks like it says we have more time. Stage 3, capital deployment. The surplus is saved, lent, or invested. Someone borrows the surplus to build a mill, pays it back with interest, and generates entirely new surplus. Yeah, it's magical. Until every member of society has access to tools that produce a surplus, this cycle cannot begin. Lending didn't change civilization. Tools did. Lending merely carries the surplus forward. All right, so now we're going to go into this book. So this is just a reminder that, why did I say we're going to be talking for 2 years? So here's week 1 to 7. And then we're going to be moving to week 8 to 17, 18 to 30, 31 to 40, 41 to 50, 50. Wow, we got a lot of topics to cover. For 2 years, we're going to be doing this. All right, but we're still in week 1 to 7. So we're covering these 2 books next week. All right, so today, the next section I'm going to be talking about is from the book Manias, Panics, and Crashes. It's only one little section. And then we're going to look at part of chapter 1 of The Intelligent Investor. Next week, come back for the fur trade in Canada. Usually, I also put in a plug for my little project, my Qubit Connect project I've been working on for a really, really long time. I don't have anything to show you. I didn't push the changes to GitHub, so I'm not going to show you how this thing works today. Let's just get back into our content. All right, so this is from the book Manias, Panics, and Crashes. Something called Kipper-und-Wipperzeit collapse. Okay, Germany in 1618, a pathological financial episode. What happens when assurance completely collapses? To fund the impending 30-year war, princes, abbots, and the Holy Roman Emperor systematically debased subsidiary coinage. They substituted base metals for silver and raised the face denomination to extract seigniorage. Entrepreneurial smugglers took these bad coins across borders, swapping them with ignorant commoners for good coins, bringing the good coins home to melt and debase. More mints opened. Debasement accelerated in a hyper fashion. The subsidiary coins, the only money used in daily transaction by common people, became practically worthless, as in the Tolstoy's Ivan the Fool. Children played with them in the streets. The core IOU was broken and the economy seized. All right, what's going on here? So remember that in all of the different transactions that we've discussed so far, we have one person who's passing an instrument across the table, And then you have another person who's passing another instrument across the table. And at the beginning, the two instruments were both goods. And then in the next example, one was a good and one was the good, but from the future to now. And then the next example was someone was passing money across the table. And then the other person was saying that I will give you that exact money plus interest. So what's this? What do you mean the Holy Roman Empire? So princes, abbots, Holy Roman Empire. Okay, so some group of people, they decided, okay, we're smarter than everybody. So what we recognize is, I mean, we don't even have to say it's a coin. Like, okay, it's gold, or what? Or it's a cow, or it's any good, or it's a hammer. And so I gave you the hammer, and then you pay me back. You give me the money for that hammer, or you give me a chicken for that hammer. You're trading me. And what I'm saying is that this is a good quality hammer. And then I go to use it and it breaks. That's the basic idea here. So what happens is these guys, they take a coin and then they say this coin is silver. And then I give you the silver coin and then you give me those gold coins back. And then I take the gold coins back to my own country. And then you realize this is not silver. All right. So it's like, it's theft. It's theft. I mean, like there's a difference, the difference between robbery and theft. All right. So with robbery, it means that I take a gun and I threaten your life and then I ask for your goods. And then if you don't give me the goods, then I kill you and then I take them. This is robbery. Theft is when I go into your home when you're not looking and I just take your stuff. Now, in this case, so what is this? Is this robbery or theft? Because what you're doing is you're saying that I'm going to give you this thing. I'm going to trade with you, and then you're going to give me something of value. But the thing which I give you is not actually the thing which I claim it to be. So there's no assurance. There's no trust. I'm using the trust that you think is happening in the transaction in order to take advantage. Now, obviously, what happens is the people who are giving up the good money and the people who are receiving the good money are going to benefit, and the people who are receiving the bad money are going to have a hard time. Debasement as tax on the poor. So the Kipper-und-Wipperzeit was not a unique historical anomaly. It is a universal template for monetary failure. Sound money, debased money. Large denomination gold and silver coins held exclusively by wealthy were never debased. The prince extracted the seigneurage. Only the small subsidiary coins used by common people were targeted. The peasants paid the absolute price. This is the pattern of all debasement. The closest to the creation of money benefit first. Those furthest away who hold their wealth in wages rather than hard assets are the last to know and the hardest hit. Inflation is simply debasement with better marketing. All right, so now what's the government doing? The government prints all of this money. And then, okay, so what happens is they're the first to print, they're the first to spend. All right, so they print $1 billion, and then they go and spend $1 billion in the market. Now, when they spend their $1 billion, they can trade that $1 billion for $1 billion of goods. But the problem is that inside of a closed system, then let's say that there was $9 billion in that system. And then they just print and they put another $1 billion into the system. Now we have $10 billion in the system. But the $10 billion of the system represent the total productive capacity of all of the goods and services in that place. All right, because remember that the money is it's a representation of the value of the productivity that's been created, and maybe some other things. But in general, you can see what happens is we have a 900 milliliter a bottle of Coke, and then we're going to pour in 100 milliliters of water. Scaling the promissory note to the global markets. Once a society possesses surplus, a lending apparatus, systematic assurance, markets, complex markets flow naturally. Societies must decide who gets the surplus capital. While a bank intermediates loans, a stock market intermediates ownership. Okay. So we're talking about privatized owner. So we're talking about public ownership of companies. So in when we talk about a bank, then we're talking about proprietorship. We're talking about one person. They go to the bank. They say, "Hey, I want a bank loan because I want to start a company." And then at some point, we have something called a public company. Are they called public companies? And then so they list them on the stock market, and you can purchase shares in that company. So if you so the company is now, I'm always kind of confused between a stock and a bond, because my understanding is a bond is when a company wants to borrow money from the public, and then they issue bonds, and then they pay back those bonds. But then the stock market is when a company is owned by other people. So like, I don't see how does a company use the money that is going into the company from people purchasing their shares, because it only represents ownership. So if a company wanted to use that money, they would have to issue shares and then sell those shares. But how do you sell more ownership to a company? That's a question. Okay, you are buying a piece of their future productivity. It is a promissory note with no fixed repayment date backed by the assurance of a corporate cash flow. All right, so this is the issue. So like, I hear a lot of people talking about what's that oil company? Centron or I don't know, it's an oil company, and they're like saying that this oil company is priced extremely low right now, and then the price of oil is definitely going to go up, and then they you can own the company at this price, and then probably the share price is going to go up. They also pay a dividend. So if you own ownership in this company, every single quarter they're going to give you some money. They're going to pay you as an owner of the company. So all right. The modern stock market is simply the historical promissory note system scaled to millions of simultaneous participants. This is exactly where Benjamin Graham enters. This is exactly where Benjamin Graham enters. And his first question to market participants is brutal. Are you investing, or are you just speculating? Defining the intelligent investor. An investment operation is one which, upon thorough analysis, promises safety and principal and an adequate return. Promises safety of principal. Okay, so you're not going to lose your original money, and an adequate return. Okay, so then that means you're going to earn something. Operations not meeting these requirements are speculative. Investor. An investor is following the great market decline of all common stocks were widely regarded as speculative gambles. Yet by the 1970s, everyone who bought or sold a security was suddenly called an investor, regardless of what they bought, why they bought it, or whether they bought it on margin. Wall Street intentionally transformed a precise, mathematically rigorous word into a comforting marketing term. Graham spent his career trying to take that word back. All right. So the thing is, like, it shouldn't be called, like, everyone who's buying stuff in the stock market, they shouldn't be called investors. They should be called speculators. They're not actually investing, they are speculating. So that's the first point. Three failing strategies for beating the market. Three failing strategies. Enterprising buyers often attempt, so this is from the book, The Intelligent Investor. Enterprising buyers often attempt to generate above average returns. Graham identifies three common strategies and is deeply skeptical of all of them. Market trading, buying when the market advances, selling when it declines, or short selling borrowed shares. Market trading. So this is like a very, very common, everyone's market trading. A lot of people are trading. So like my parents, they had a financial advisor, and that's all that he would talk about. Okay, so here's something which is like, it's these stocks are going up, so we should buy them, and then these are the stocks which we own, and it looks like they're going down, so we should sell them. That's it. That was his whole strategy. Number two, short-term selectivity. Buying companies expecting to report suddenly increased earnings or favorable short-term developments. Okay, short-term selectivity. So, okay, this is talking about right here. So the news. So something in the news, it says that this company is like going to do really well. Now, this is what Peter Schiff says: buy the rumor, sell the fact. So when you see something in the news, then you buy because the rumor is that something's going to be happening. Everyone's excited, and then just before it happens, the actual fact happens. Then you sell, because there's no guarantee that what's actually going to happen in the end. All right, number three, long-term selectivity. Buying companies, often in tech, drugs, or electronics, with exceptional records of past growth, assuming will continue ident- indefinitely. All right, I heard the guy talking today, and he's like basically one of the main things that you'll notice in the stock market is there's a cyclical pattern. So you go like you're into commodities, and then tech, and then commodities, and then tech. So because in order to produce the commodities, you need the tech, and then once the tech like is able to like okay, so then you need. So he was saying like they created like the all this investment went into the stock market, and then it not the stock market into computers and the internet, and then eventually they built out all of this infrastructure, and then there was like a repricing, and then the money went into the commodities. So okay, but now we have to go and actually have to produce stuff with that software, like because you can't just have all of the value in tech. You have to be able to use the tech in order to actually produce our reality. And then suddenly we started. So then we went into a commodities cycle, and then the commodities it started to go pushing back into tech. So they said, like for example, in 2015, nobody's was buying Microsoft. Like it just wasn't like a really great investment. But now suddenly it's like it's blown up. So, but then the money is all in tech. They call it what is it these days? The FANG stocks or the Fab Seven or the I don't know what they call them these days. Anyways, all the money is in these tech stocks, but then we need to build data centers. Well, how are we going to build data centers? Well, we need actual physical commodities in order to build those data centers. So now there's a bid that's going back into the commodity super cycle. The unforgiving nature of professional competition. All right, and this is what makes me feel the most sad because I spent my whole life like trying to improve my understanding of the world around me, and like I've learned several languages, and at the end of the day, like I'm up against a lot of competitors for any specific thing that you want to compete for, and it just seems like everybody else has all the same information that I have, maybe even more, and so it seems like okay, I have a decent, what do you call it? Not a GDP. What do you call it about your smarts? IQ. I have a decent IQ. Takes me like 3 minutes to figure out the word for IQ. Uh-oh. All right. So it's not difficult. It is no difficult trick to bring a great deal of energy, study, and native ability to Wall Street and still end up with devastating losses. In the stock market, your competition is not other amateurs. Your competition consists of thousands of professional analysts whose entire existence is dedicated to knowing next year's earnings before you do. To win a short-term or long-term selectivity, you must theoretically be right when professionals are entirely wrong. As Graham asks, how many enterprising investors could count on having the acumen or prophetic gift to beat the professional analysts at their favorite game? Virtues like energy and study, if channeled into the wrong direction, become indistinguishable from handicaps. So it's like, yeah, good luck. Because, like, you have a million autistic dudes that are savants. So how are you gonna deal with savant autistic guys that they can see things in 3D and you're only seeing things in 1D? Separating intelligence from unintelligent speculation. Graham does not forbid speculation entirely, as he notes outright speculation is neither illegal, immoral, or for most people flattening into their pocketbook. Risks exist in every transaction. However, there are three distinct ways speculation becomes unintelligent: speculating when you actively believe you are investing, speculating seriously without the proper knowledge or skill, risking more money than you can afford or lose operating on margin. If you must speculate, set aside a small separate fund. Never add to it just because profits are rolling in, and never mix speculative and investment operations in the same account or for. Okay, I don't have no idea. I mean, you can make your own money decisions. But in the book Intelligent Investing, it said you need to know the difference between these two and don't think that you're investing when you're actually speculating. And so separate the accounts, separate the thinking. All right, so the last slide, here we are, the uncomfortable path to outperformance. Graham's logical conclusion for the intelligent investor is both simple and deeply uncomfortable. To enjoy a reasonable chance of continued, better than average results, your policies must meet two absolute criteria. They must be inherently sound and promising. They must be completely unpopular on Wall Street. It means you have to wait. If everyone is doing it, the advantage is already priced in. The true opportunity lies in discrepancies between price and value, buying neglected issues clouded by unjustified popular prejudice. Who wrote that? Buying neglected issues clouded by unjustified popular prejudice. I have no idea what that says. Buying neglected issues clouded by unjustified popular prejudice. The market is frequently wrong. But being right when the crowd is wrong and profiting from it requires a physiological stamina and patience that most participants simply do not possess. All right, and that brings us to our last point, which is like I saw that the note of Warren Buffett that shows that Warren Buffett's sitting on what is it like 300 and something $billion or million? Was it million or billion? He's just sitting on this huge amount of capital. He's sold out of his stocks. He's just sold, 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 sold. And they said, why are you sitting on so much cash? He said, everything's overpriced. We're at the top of a bubble. Like, it's just crazy because you have like all of the financial markets are like have completely blown out of proportion. And then somebody turned off the gasoline. So, anyways, as you can tell, a lot of people are feeling really anxious these days. And if you're feeling anxious, then I would recommend exercise and seeing a professional for whatever it takes, because you don't want to do bad things. You don't want to have bad behavior. You don't want to have bad habits, but also you don't want to have to like deal with your anxiety and your fear alone. It seems like everything is going to be a little bit crazy for a little while, and in that case, I would recommend getting help. So I hope you enjoyed today's video, and we'll see you next time. Bye-bye.